Blackboard, right? I guess you would have seen the announcement regarding the final examination. I actually discussed with the class on Monday, right? I was thinking about the length, right, of the exam, whether it's going to be 2.5 or 3 hours. And I was about to leaning toward 3 hours, but I come back and think about it. So I think it's optimum, right, to have exam for 2.5 hours, and I will make sure that the amount of question and the length of the exam, right, are consistent to each other, right? The exam there will not be too many questions, basically. So with the final exam, right, I will do it on the system. So basically, you for multiple choice, right, you simply log in, right, and do the exam on Blackboard system. So use mouse and click, right, to choose the choice of that you select. For short answer question, right, there will be question on the Blackboard, and you simply type in the system, right? So there'll be a space for you to type, use keyboard to type the answers, okay? So this time, right, don't worry about scanning and writing, right, on paper, because everything will be done online, okay? And it's going to be an open book exam, right? The only thing that I will not allow, right, for the exam is to for you to search for resources on the internet, okay? So that is not allowed, right? But if all the documents are in a hard copy or files that we've been using in the class, then that's fine, okay? So only online resources are not allowed, okay? I can talk about the exam more, right, after the end of the class and also next week, right? I have probably write about 30% of the questions so far, so still have 70% more of the questions to write. คุณอัธวัฒน์ yes
อาจารย์ครับ what about the textbooks in bookshelf
the textbook I think I have to give you the trust that's fine if it is the textbook that we use, right, if it is lecture note, that's fine. So right, I just have to give you the trust that you will not use the internet, okay? It's quite difficult to invigilate online exam with open book type, right? Yeah, right. We will talk about the exam more, right, if you have questions later on, right? So let's go back to the lecture, right? I have not really completely finished lecture 11, right? I have small part left, so let me go to that, okay? We were talking about international diversification, right? I starting by showing you the potential benefit, right, of international diversification based on theory, and then we look at the actual risk and return information, right, and see whether by diversifying overseas, right, investor can push the efficient frontier, right, toward the upper left hand side, and we see that benefit, right, from international diversification is supported, right, by empirical evidence, right? And this is important, right? If I start by showing you this graph first, okay, let me search for it. So this is lecture 11, right, page 31. Okay. So this graph, right, show us the potential benefit from international diversification. The implication of this result to corporate financial manager is that if they can get right access to this kind of investor, basically if they can raise fund right from investors who can diversify across countries like that, right, there is a potential for the firms to reduce the cost of capital, right? Because for this kind of investor, right, the perception about systematic risk, right, is smaller, right, than if you compare to domestic investor, right? So potential benefit is there, right? But whether investor actually take right advantage of this benefit or not, that's another question, right? So far, I only show you potential benefit, right? And if investor really take advantage of these benefits, then right, the implication for the firm is that right, getting access to this kind of investor will allow the firm to reduce the cost of capital, right? Now going back to the investor, whether they actually take advantage of this potential benefit or not, that's another question, right? And the answer to this question has strong implication for corporate finance, right? If I go down, apparently, if you think about CAPM, right, you go to page 45, 46, right? This is page 46 with the heading of international CAPM. Apparently, we use CAPM, right, to calculate the cost of equity capital, right? But in practice, right, there are two versions of the CAPM, right? This is called international CAPM. The next one, right, this is called, the first one I have for you here is domestic version of the CAPM, right? But if you go to the next slide, that would be the international version of the CAPM. So the difference between these two versions of the CAPM, right, has to do with the market portfolio, right? Normally when we apply CAPM, right, in Thailand, we simply use the SET index, right, to represent the market portfolio. So if we use the SET index, right, to represent the market portfolio, the implicit assumption, right, the implicit assumption of that practice, right, is that we assume investor can only diversify across the Thai markets, right, but not outside the Thai market, right? So that is domestic version. But if we assume that the shareholders or the investor can diversify, right, across countries, right, in that case, right, the reference market portfolio will not be a single market anymore, right? So that when we get the international version, in this case, the market portfolio must be represented by equity market index that cover, right, that cover more than one equity markets. And apparently we have that kind of index, right, that we can pick, right, from the market, right, that is called MSCI World Index or MSCI Global Index. I put it there, right? So that kind of index is available. So as I told you, right, whether the investor take advantage of the benefit from diversification or not, right, would have implication for corporate finance because it will affect our choice, right, of the version of the CAPM. So if you believe that your shareholders are mainly international investor, then this will be the version of choice, right, for calculating cost of equity. Right. On the other hand, right, if you strongly believe that most of the investors still a domestic investor, then in that case, domestic version of the CAPM will be more appropriate. Okay. I have, right, you are right. With risk-free rate, right? With the risk-free rate, there is no global risk-free rate, right? There is no global risk-free rate. So with the risk-free rate, the firm still have to refer to domestic risk-free rate, right? So with this particular variable, right, that there is a limitation. The reason why we don't have global risk-free rate is that different countries have their own currency. So if I use US government bond, right, to represent risk-free rate, that will be risk-free only for US investor. For Thai investor buying US government bond, even though there is no default risk, right, but we still have to face exchange rate risk, right? So you are right. The sticky point is with the risk-free. There is no global risk-free rate, right? So you still have to use domestic risk-free rate in both versions, right? In both versions, use the same. Okay. Next, right? What I want to show you next is the evidence, right? Whether investor actually take advantage of international diversification benefit, right? So you have to go up. So let's go up, right? Go to page 41, right? Go to page 41. Apparently in the literature, there is a group of evidence, right, known as home bias. Basically, this kind of research, right, what the researchers try to do is that they try to investigate the composition of investment portfolio of investors from different countries. What they found is that, right, even with better access to international stock, investors in most countries still bias their portfolio toward home securities, meaning that they still do not take advantage, right? They do not take much of the advantage from international diversification. So basically, when they construct their investment portfolio, investors tend to bias, right, the weight toward investment assets at home, and this is called home bias. So basically, with the potential benefit, right, we found that investors do not take full advantage of that benefit, right? But as time passes by, right, this is evidence from 1995, right? If you want a most recent one, right, you go to the next slide, right? I found that in 2002, right, a bank called UBS, right, tried to do similar kind of study, right, and they found that home bias still prevalence in that sample, right? It's just that investor, right, become more and more, right, international over time, but still, right, they still have the bias, right, toward home securities. Okay. So with this kind of evidence, right, then when we calculate the cost of capital, I guess we have to take side. So basically you have to choose, right, whether you believe, right, whether your investors are international or whether you believe that your investors are mainly domestic, right, and that belief will dictate the version of the CAPM that you choose. Okay, for me, right, in the next topic, right, I will talk about how the cost of capital can be calculated. So for me, right, I want to stick with the domestic version of the CAPM, right, by citing the home bias evidence, right, that investors do not take full advantage of that benefit. Okay, again, right, which version you use, I guess that's up to you, right? You just have to justify your choice only, right? Okay, so that's it, right, for this topic. right? So let me quickly move on to the next topic, which is related to this one, right? That is how to calculate the cost of capital. Okay. This is topic 12, right? How cost of capital can be calculated, okay? I just have to wait for the, okay. Right. When we calculate the cost of capital, right? The main use of the cost of capital, right, is for project evaluation, right? That is the main reason why we want to calculate the cost of capital, right? So you have to keep in mind first that, right, the reason why we calculate the cost of capital, right, is because we want to use it, right, for project evaluation. So in this topic, right, I want to focus on projects cost of capital, which could be different from corporate-wide cost of capital. Okay, so the focus in this topic is project cost of capital, right? Normally we calculate the cost of capital, right, in the form of WACC, right? And that consists of cost of debt and cost of equity. Why do we calculate cost of capital as WACC? Why don't we just focus on either debt or equity? And if you remember, right, the first thing you study in corporate finance is that the main objective of the firm is to maximize shareholders' wealth. So if we want to maximize shareholders' wealth mainly, why don't we just focus on KE, right? Why do we have to calculate cost of capital as WACC, right? The reason being that, as I told you, right, we calculate cost of capital because we want to use it for project evaluation. So if you think about project, right, from the perspective of the balance sheet. So this is the balance sheet of a project. On this side, we have assets. On the other side, we have debt plus equity. So when we evaluate value of a project, right, we want to know whether it is worthwhile to invest in the project. A project is a set of assets. So that is a project, right? A project is a set of assets, right? Land, equipment, right? Factory, right? Inventory, and so on. So that's project. So the main purpose of project evaluation is to calculate value of the whole project. So if we want to know the value of the whole project, right? The financing part, right? We have to take into account both sources of fund, right? Debt and equity, right? And that's why when we calculate cost of capital, we calculate it as weighted average cost of capital, so that we can use that, right, as a discount rate, right, to the cash flows from the whole project. Okay, right. So in that case, right, we would have to know how to do the cost of equity and cost of debt separately, right? And the final piece, right, of the calculation is the weight, right, the proportion of debt and equity in the capital component. Now today, right, I will not spend time on the cost of debt since we have done this, right, in the topic of international financial markets, right, when we try to calculate the actual cost of using bank loan, right, the actual cost of using short-term debt security and bond as well. So that one has been done many times. So I will not focus on it, right? I focus on these two. Right. So today we focus on this side of the balance sheet, right, of a project. Okay. Next topic, we will focus on this side, on the project. Before I move on, if you look at capital components of a firm, right, there will be more detail than just debt versus equity, right? For example, in debt, right, there could be short-term debt and long-term debt, right? Furthermore, right, debt can be also come from bank loan, right, or bond, right? And we know that the cost of debt from different sources, whether it is long-term, short-term, it is bank or bond, right? The cost of debt financing is not the same for all types of debt, right? We know that they are different. But today, right, to make things simple, right, I want to just treat this whole thing as debt, okay? So assume that there is just one source of debt, and we calculate the cost of debt in one number. Now, when it comes to equity, right, we also know that in equity account, right, there are paid-in capital. So this is the money that shareholders pay to the firm, right, to buy stock, right, issued by the firm. Another source of equity capital, right, is retained earnings. Even though these two sources belong to shareholders, but when it comes to cost of capital calculation, we know that they are not the same, right? The cost of paid-in capital, right, firm issue new security, right, new stock and sell to the market, is normally not the same as the cost of using retained earnings. At least using retained earnings, there is no flotation cost. Issuing new stock. If the firm sell a stock for 100 baht, the firm will receive a net funding, right, of less than 100, because underwriter, right, will charge upfront fee, right, for the service. So in that case, right, paid-in capital will be a bit more expensive, right, due to the flotation cost. Furthermore, right, we also learned that when firms announce that it want to issue new equity, such announcement tend to be perceived by the market as bad news. So when firm announce, right, new issue of equity, stock price tend to drop, right? Stock price tend to drop, so that's bad news. So that will also increase the cost of capital, right? Basically, paid-in capital, right, is subject to the problem known as information asymmetry, right? But retained earnings doesn't have that kind of problem. But retained earning could be subject to HSC problem, right? So what I try to say is that look at them in more detail, right? The cost of these two sources of equity capital might not be the same. Okay, today I just want to ignore all those details, right? By assuming that I just look at them as one, right? One source of fund, right? And there will be just one cost of equity capital. And since I ignore fees, right, for selling new stock, right, you can think of that KE as come from mainly retained earnings. Because if the firm have to raise new equity, right, we have to take into account the flotation cost, right, as part of the cost of capital. Okay, right. So that's the detail. Okay. Another thing that two more things that I have to pinpoint, right? The first is that the term cost of capital. Basically, firm use the cost of capital, right, to make investment decision. So this number, right, must reflect, right, the minimum return, right, that the firm feel acceptable. So this is the minimum return that a project must generate, right? Otherwise, the project is not acceptable. So this is the minimum rate of return that a project must generate, right, to be considered as being acceptable. When we calculate cost of capital, we calculate this number from the perspective of fund provider, right? We calculate this number from the perspective of debt holder, shareholders. So it must reflect, right? This number must reflect the minimum return demanded by investor, right? This number must reflect the minimum rate of return demanded by investor, right? And we call that the required rate of return. So cost of capital should reflect the investor's required rate of return. Okay. Another thing I have to point out is that cost of capital for the whole corporation and cost of capital for a project could be different, right? They need not be the same. Unless you are the firm that has one line of business. If you are a firm that has more than one line of business, then you have to keep in mind that cost of capital for the whole firm and cost of capital for each business unit or each project could be different. Okay, so they need not be the same, basically. So you have to treat these two numbers as not being the same, right? Corporate-wide cost of capital versus cost of capital for a single project. Okay, let's look at this example. Right, this is risk. If you believe in cap M, right, that risk is systematic risk. Let's say beta. This is the required rate of return by investor, or basically that's the cost of capital, right? We know that, right? We should start from risk-free, right? And in equilibrium, right? Cost of capital should vary with the level of risk in positive manner. Now, if I am a firm that has two business units, right? Unit A is a low risk unit. Unit B is a high risk unit. Now, because I have both units, right, as part of my assets, right, in the balance sheet. So when I measure my own risk, right, I have to weight average between the risk of the two units. Assume that two of them have the same level of, the size, right? Assume that the two business units have the same size. So therefore, the firm risk will be the average between the two. So that is the firm risk. Let's call C. C for corporation. Now, when I calculate corporate-wide cost of capital, right, I will map that. By the way, this curve is known as SNL, right? So that would be corporate-wide cost of capital. Let's call that KC, corporate cost of capital. Now, when BUA come up with a project, and then BUA come to the center, right, to ask for capital. So if the firm, right, use corporate-wide cost of capital to judge project proposed by business unit A, you see that since A, right, is in a low risk business. So if A is in a low risk business, most likely the return from project, right, of A will be low, right? So based on the project risk, the cost of capital should be at KA. This is based on the risk of the project. But since we use corporate cost of capital to judge project A, right? In the end, we will tend to reject right, project, right, proposed by unit A. As for B, B is in a high risk business. So if B propose project, most likely the return from the project will be high, right, due to the risk is also higher. So based on the project risk, right, based on the project risk, we should charge KB, right? We should charge KB for the project. However, if the firm use corporate cost of capital, right, as a cost of capital for project B, you can see that it is lower. So in the end, the firm will tend to accept, right, projects proposed by B and reject those projects proposed by A. You know what happened over time? As time passes by, right, the size of unit A becomes smaller. The size of unit B become bigger. And as B become bigger, the risk of the corporation start to move toward the right-hand side. In the end, the cost of capital will be equal to KB. Right? So basically what this exercise tries to tell us is that when we use corporate-wide cost of capital, right, to evaluate, right, specific project, you might miscalculate NPV, right? Because project risk and corporate risk could be quite different, right? Corporate risk is the average risk of all the projects, right? So a project at hand could be higher or lower risk than the average, right? So the best practice is to calculate cost of capital for a project, right? To do project evaluation, okay? So basically cost of capital is project specific, right? We do not use corporate cost of capital for that purpose. The only time, right, that the corporate cost of capital will be the same as the project cost of capital is when the firm is not a conglomerate firm. So if you do project B, right, let me go back to that. Okay, let me draw SML a bit more extreme. So if B, right, propose a project, we shall use KB as the cost of capital. Now assume that project that B proposed has the IRR, right, of this. So this is the IRR that the project generate. Now, if we use KC, right, if we use corporate cost of capital to judge this project, you can see that the IRR of that project is higher than KC. Right, so using corporate-wide cost of capital, we will accept this project. Right, even though the project lie underneath the SML. Right, using project-specific cost of capital, KB, we will reject. Right, can you see the difference? This is the project that B proposed, right, and that's the IRR from the project. So if you use the project cost of capital, KB, you will reject. Using corporate cost of capital, you will accept. So which one is more correct? Which one is more correct? This is important question, right? Because if you pick the wrong one, you make wrong decision, since the two choices lead to different decision. As I told you, right? If you use KC, right, don't forget this project is very risky, but KC is reflection of the average risk of the whole firm. Right, so in that case, right, the correct choice would be KB. So use basically, if a firm is a conglomerate firm, right, the best practice is that you will not assign the same cost of capital to different business units, right? Cost of capital should be calculated specifically, right, specifically for each unit, right? Keep in mind that corporate cost of capital is just the average number, right? So use KB. Right, so with this in mind, right, we can move on. Right, today I want to focus on the project, right, not the corporation. This is the WACC calculation, and I am quite sure that you all are familiar with this, right? Therefore, I just put it there as a documentation only, right? We will not go through it. That is the proportion of equity in the total financing, right? And this is the proportion of debt in the total financing. So the sum of the two must be equal to 1, right? I mean, sum of the weight. So if you sum up these two numbers, right, they must sum up to 1. So basically, V is asset, right? V is the value of the asset of the project. Okay, right? Let me move on. KE, right? Between KD, right, cost of equity, sorry, KD, cost of debt, and KE, cost of equity, right? Between these two, right, you will find that cost of debt is easier to calculate than the cost of equity, right? Therefore, I will not spend time on it, right? Cost of equity is a lot harder to estimate, right? For listed company, right? For listed company, there has been some surveys in the past, right? Especially in developed market, we found that the most popular technique that firms, right, listed firms use to calculate cost of equity is this one, CAPM, right? It's mainly used by listed firm, right, to calculate cost of equity, right? Since project risk and firm risk could be different. Therefore, if I am calculating the cost of equity for a project, the term beta must reflect systematic risk of the project. That one, that beta, right, must reflect systematic risk of the project, right, not of the firm, right? This is project risk. Okay. Now, what we do normally is that since project, right, is not an entity, right? A firm is an entity. So it is the firm who issues stock, but a project doesn't issue stock. So it is quite difficult to measure the beta of a project, right? For the fact that project doesn't issue stock. The entity that issues stock is the firm. So beta of the firm stock reflect average risk of all the project the firm invests. So we don't want to use firm's beta, right, for this purpose. So normally what we do is that, right, if let's say CP, right, CP want to invest, think about CP. Jalan Pokapan, right? So they also have this company, right? Have what 7-Eleven, right? CPO, right? Also have a lot of things to do with retails, right? Business. Now suddenly the firm, right, want to invest in a new business, right? Assumed to be satellite. Service. So if CP, right, want to enter into a new business, right? Let's say this is a business to provide satellite signal service. So CP, right, shall not use firm's beta, right, for this project, because the risk of the existing asset and the risk of this project are totally different, right? This must be a lot riskier, right, than the retail business. So what normally firm will do is that, right, they will go to the stock market and look for firms, right, look for firms that have this business. So basically look for firms that are in the same business as the new project. And we will use that firm as a proxy for the project. So look for proxy firm, right? And this proxy firm, right, preferably we should find a firm that only compete in one line of business. So if a firm has only one line of business, we call them as pure play. So in this case, right, you might think of Thaicom. So if CP, right, identify Thaicom, right, as a pure play, right, the firm that only compete in this business that CP is interested, right, then we can use Thaicom as a proxy for the project. Simply calculate beta E of that stock and borrow beta E, right, for the project. Okay, so that's what we normally do, right, in practice. So we have to identify a proxy firm, right, and use the equity betas of the proxy firm, right, for the project. Okay, so after you identify CP, right, you collect information, identify Thaicom, right, then we use return on Thaicom stock, return on the set index, right, and then calculate beta, right. This is what we do normally. Okay. So that is a review, right, of how we calculate the cost of capital. Now, when it comes to foreign project, right, this is what many multinational corporations will do. So first, right, they calculate the cost of equity for similar project at home. And if the firm have to do this same project in another country, right, outside home country, then they will add another term, right, to capture risk premium. And firms will call this additional term as country risk premium. So basically calculate beta, right, for similar project at home first, right, and then normally firms perceive that project in foreign country will be riskier, right, than the same project, right, operated at home. Then therefore, since the perception is that foreign project is riskier, we shall demand, right, additional return for it. And that is captured by a separate term called the country risk premium. Firms normally justify the use of country risk premium, right, that it will capture two main types of risks of a foreign country. The first is political risk, right? This is the risk that the business environment, right, including political environment and also regulation environment of the foreign country could change in such a way that it is harmful, right, to the profitability of the project. Another source of risk that CRP tries to capture is currency risk, right? Because the cash flow from foreign projects will be in foreign currencies. So when we send the currency back home, right, there will be some risks, right, associated with future exchange rate. So that's what firms do in practice. Okay. However, right, this kind of practice, right, ignore the fact that foreign project can actually help the firm and including the shareholders to diversify risk, right? So if you do this, right, it means that you only treat foreign project as adding more risk to the firm. But on the other side, foreign projects can also help the firm to diversify risk. So this kind of practice, right, ignore that benefit, right, of foreign project. And if you ignore that benefit and you only add risk premium, there is a chance that, right, the firm will over discount project. Over discount means you bias NPV toward negative number because you add risk premium to the discount rate. So the result tends to be no to foreign project. So that means the firm might underinvest, right, with this kind of practice. Okay. Last week I have a story. I mean, not last week. Last Monday, right? I have a story telling your friend in another group. Let me explain the term over discounting a little bit, right? So that you can see why in academic, right? We say that this kind of practice might not be appropriate. Okay. The story I told your friend in the other class is that last week I had a reunion with my university's friend, right? Have not seen them for some time, right? A big group of friends, undergrad friend. We studied together quite a while ago, about 30 years ago, right? This is, yeah, more than 30 years ago. What happened was that, or I found that, right? I found in that reunion meeting that I have a lot of female friends who are not married. And then because we are quite old now, right? So getting married or not getting married is the result of a decision, right? So I start to wonder what happened in that decision making, right? So I start to interview them, right, about the decision, right, not to get married. I found that this group of friends, right, who are not married, when they were young, studying in the university, a lot of male friends actually try to court them, right? Try to become boyfriend to them. But this group of my friends, right? They are basically they study economics, so they treat having relationship with opposite sex, right? Is an investment. So they treat the decision as an investment decision. So before deciding whether to become girlfriend or boyfriend with another person, they have to evaluate the project first. Basically, what they wonder is that they wonder whether this guy who comes, right, will become an asset to them, or will become liability to them. So any guy that come to court, my friends, right, they will evaluate NPV of the person. So this is like investment project. So if NPV is positive, that means the person is likely to become an asset to my friends. But if the NPV is negative, that means the person who come, right, is likely to be liability to my friends, basically become burden, right, become burden. We don't want liability, right, we want asset. However, my friends, they are highly risk averse. They are highly risk averse at the time. So because they are highly risk averse, they demand more return. So the expected return that they want for anybody who comes is very high. So once they discount, right, the proposal, NPV become negative. And therefore, they decide not to invest, so not to have relation. Now I ask them, what if somebody come today, right? Would you reject or accept the proposal? They said, because now, right, this is probably the last chance that they might get married. So now if anybody come with a proposal, my friend will not discount anything, take it at face value, meaning that ready to take risk. So we'll accept any proposal now, right? Then I think about that decision in a business world. What is the risk of not investing? What is the risk of not investing? We normally learn about risks of investment, right? How about not invest? Is there a risk of not investing? For a business, right? If you don't invest, the risk is that your business will decline in the long run, right? Because you cannot catch up with your competitor. So apparently in a business world, there is also risk of not investing. That's right? The opportunity cost of not investing is that you cannot catch up with your competitors. Think about retailers in Thailand. We call show hoi, right? Those shops. Because they don't invest, right, to improve their business model over time. So once 7-Eleven come in, right, a lot of Thai traditional retailers cannot catch up, cannot compete, and they die down. Right, so now you see 7-Eleven everywhere, right? And those traditional retailers, right, have to, accept, right, less and less margin. So in a business world, right, not investing is also risky. Just like my friend, right? When they are so risk averse, they decide not to invest. And suddenly they found that they lag behind. And now whatever risk, right, as long as there is a proposal, they will take. And that kind of decision making, I don't think rational, right? When you are so afraid to risk, you basically decline all the proposal. And once you start to realize that you lag behind, you will accept any proposal, taking any risk that come, right? So this is the risk of over discounting. Just like my friend, right? So when we calculate the risk, the discount rate, right? When we calculate the discount rate, we don't want the number to be too high or too low. We want the number to be just right, right? So this kind of practice, even though it is conservative, right? I would say this is conservative kind of practice, right? But there is a risk, right? That you might over discount and therefore you reject too much. Right, so what I want to show you today, right, is how to come up with the cost of equity calculation that take into account diversification benefits of foreign projects, right, of international diversification. Okay, right. Let's move on. Okay, this is the risk, right, of a project. Apparently, when you look at project risk, right, and measure it, the magnitude of the risk depends on how you look at it, right? So what I try to put here, right, on this slide is that I want to look at risk of a project from 3 perspectives, right? If you look at the risk of the project from the project manager point of view, right? We call this standalone risk, right? But when a corporation look at the project risk, right? They might come up with different measure, right? And that viewpoint is called corporate risk. This is the this is the measure of project risk from the corporation point of view, right? Standalone risk refer to the project risk measured from the volatility of the project cash flow. Okay. But corporate risk, right? We look at the project, right? But we care about how the project contribute to the risk of the overall corporation. Now, there is another perspective of a project risk. That is when the shareholders look at the risk. This is called market risk, measured by beta. Apparently risk of a project, right, can be measured from different perspectives, and the result will be different as well. Here, right, I assume Honda. Okay, let's think about Honda. Honda from Japan. This is Honda Holding, which is the mother or the parent company. So Honda invests in subsidiaries, right? So Honda has an operation in Japan, right, Indonesia, and Thailand. Now assume that Honda Thailand want to propose a project to Honda Holding Corporation. So I want to think about project in Thailand. Of course, Honda Thailand need to raise money, right, to invest in the Thai project. So Honda Thailand, right, will normally ask for funding support from Honda Holding, right, in Japan. So providing the money, right, to this Thai project, of course, Honda Holding must charge cost of capital, and that capital comes from shareholders. Okay. Now, if we want to measure the risk of this Thai project, you can think about risk, right, as the volatility of free cash flow. So if I focus on the volatility of the free cash flow as the measure of risk, right? So when the project manager, right, the Honda Thailand's CEO, right, the project manager, look at the risk of this project. Of course, one major risk factor is flood, because that is the major natural disaster in Thailand. 10 years ago, when there was major flood in central Thailand, Honda Thailand had to stop operation, right, for many months. There was no production at all in Thailand for so many months. And that affected the free cash flow of the Honda Thailand. So the project manager must take into account this natural disaster as one of the major risk factors to the project. Apparently, when you look at the risk of this project from the parent company point of view, they might ignore the flood. Why? Because Honda Japan say that the reason why they have an operation in Thailand is because they think that that operation can help them to diversify the risk of natural disaster. Having a factory in Japan face the risk of earthquake. Having operation in Indonesia face the risk of volcano eruption. Right? The one in Thailand have a risk of flooding, but all in allow the firm to diversify natural disaster, because major disaster tend not to happen at the same time. In the year when we have major flood in Thailand, even though the production in Thailand stopped, but you know what? Global production for Honda in that year, global production for Honda in that year, where the Thai operation have to stop, doesn't change from the previous year. That is because even though the Thai operation have to stop, right, Honda can increase production somewhere else to compensate for it, and therefore overall production remain the same. So when corporation look at the risk of this project, corporation have to look at how the project, right, contribute to the corporate risk. So assume that this is the cash flow from other projects except the new one. And this is the cash flow from the project that we want to calculate the cost of capital. You can see that when we combine these two cash flows, the firm cash flow is quite stable. Therefore, as a firm, right, when we want to judge the risk of this project to calculate the cost of capital, we have to judge from the viewpoint of how the project contribute to the risk of the firm. So in this case, right, the firm will take into account the benefit from diversification. And therefore, the firm will think about the project risk as being smaller than the project look at itself, right? Now, if you think about shareholders probably hold Honda stock, right, as 1% of the overall portfolio. So from shareholder perspective, the risk of that project is even smaller because shareholders diversify their wealth across firms, across industries as well, right? So when the shareholder look at the project risk, right, the shareholder look at how the project contribute, right, to the systematic risk of the portfolio, and that risk will be even smaller, right, from the previous two perspectives. Now, which perspective do we use to calculate cost of equity capital? If you go to the first slide, I say that this cost of capital should reflect required rate of return, right, of the fund provider. So therefore, we have to take this perspective. So this means, right, we should really take into account the diversification benefit of foreign projects, right, when calculating cost of capital, right? Okay. We will learn how to do that. Okay, we will learn how to do that, right? So to take into account the benefit from diversification of foreign projects, right? I will use the concept of the cabin, right? I will use the concept of the cabin. But to do so, there are still a lot of issues that I have to answer. Basically, I have to answer how to actually apply cabin, right, for a foreign project. Okay. So what happened next, right, is that I will answer, right, different issues, right, in applying the cabin, starting with which version. So there will be a lot of issues that I have to answer, right? So the first issue we have to figure out is which version of the cabin shall we use for a foreign project? There is no definite answer to this question, right? The answer to this question depends on the analyst assumption, right? So if we assume that investor can only diversify in their own country, then domestic CAPM will be appropriate. But if you believe that investors take full advantage of international diversification, then the international version will be more appropriate. Okay, so this really depends on the assumption. For me, right, I will use this one because for me, I feel that if we think about Thai firms, right, most Thai investors still bias their investment portfolio toward Thai assets. I would say that. Okay, so I figure out that I want to use that version, right? Next, in this version, right, I have to calculate risk-free rate. I would have to calculate the beta of the project, which means I have to identify proxy firms, right, for the project. And the market risk premium have to be estimated. Okay, so to apply that version, I still have a lot of questions to answer, right? Risk-free, as your friend just now asked, right? And this will be question also when you decide to use international version of the cabin, right? Because there is no global risk-free rate, right? There is no such things as the global risk-free rate, right? Risk-free depends on who look at it, right? Because different countries use different currency. So since, right, we calculate the cost of capital, right, from the perspective of the shareholders of the parent company. Therefore, when we look for the risk-free rate, we should think of risk-free asset from the perspective of the shareholders of the parent's company. Therefore, that risk-free rate should be the risk-free rate in the terms of home currency. So now we use the government bond, right, of the country, right, that the shareholders of the parent's company live in, right? So if the multinational corporation is a Thai firm, and assume that the Thai firm use Thai baht as functional currency, then that risk-free rate should be the Thai government bond, the yield on Thai government bond. But if the firm, right, is from, say, the UK, right, and the functional currency of the firm, right, the currency base of the firm is the pound, then they should use the yield on the UK government bond, right, as a risk-free. Okay, so that's how you look for the risk-free rate, right? And this shall be the same, right, whether you use domestic version or international version, right? Because there is no global risk-free rate. Now, once we identify risk-free, the next one is when we calculate beta, we have to identify a proxy firm. So should we use firm? Oh, by the way, when I use the term home country, and host country. Okay, home country is the country where the parent's company is located. Host country is the country where we want to invest. So host country is the foreign country, right, where we want to invest. So the question is, should we look for the proxy, right, from home market, or should we look for proxy from the host market? The idea of identifying the proxy is that we would like to use the beta of the proxy. Right? We want to use beta of the proxy to represent project beta. So therefore, when we identify the proxy, we would like the proxy, right, firm to have the same risk as the project. So basically, when we identify the proxy, we should identify proxy that have to face, right, the same kind of business, right, and economic environment as the project. So the first choice is, if we can find one, right, we would prefer, right, we would prefer proxy, right, to be the firm, right, in the host country. Because firms in host country, right, have to face similar, right, economic, business, and political environments as our project, right? So the first choice would be, right, to choose the proxy from the host, right, country, right? But that might not be possible in some cases, because if this project, right, is the first of its kind in that country, then there would be no existing firm in that particular country, right, that have the same business as the project. So in that case, we might have to use proxy from home, right? But the first choice is host country proxy. Next, right, after we identify the proxy firm, right, we have to calculate beta. So beta is the covariance, right, of the return of the proxy with respect to the market portfolio. So we have to identify the relevant market portfolio here. Three choices. I think it's quite obvious that we have at least three choices. First, use home market. Second, use host market. Third, the world market. We can use something like MSCI World Index, right, to represent the world stock market. The choice, right, I guess we can we can drop one choice among these three straight away, right? That is the host market. Because the major shareholders of the parent company, right, should be investor at home, right? Not investor in the host country. Now, whether to use home market or world market as the reference market port depends on the version of the CAPM. Since I said I want to use domestic version, then I will use home market. Okay, I use home market. If you use international version, then you use the other one, right? This is just a small detail. Okay, this is just a small detail. You can ignore because I will not ask you in the exam. The detail here is that you just have to be careful, because if the parent company is a Thai firm, so the risk-free rate is the Thai government bond, right? So the denomination of the risk-free rate tend to be Thai baht. Now, if I use international version of the CAPM, right? I have to be careful that MSCI World or Global Index, they are normally calculated, right, based on US dollar term. So if I calculate the return of MSCI World Index, right, the return, right, the currency of denomination of that return will be US dollar. So if I plug both of them in CAPM equation, I would have some inconsistency here, because the risk-free is in Thai baht. The market return is in US dollar. So do not forget to convert them into the same currency first, right? Before you plug into CAPM calculation. This is just a small detail. Okay. Normally, textbook is written from US universities, right? From US perspective. Therefore, they don't have to worry about this final, small details in the textbook, right? But as a Thai firm, right, you have to be careful, right? That is the point here. Okay. Next. Okay, at least I have to finish this part before we go for a break. Oops. There's a question. Percentage rate depends on currency. Remember, if you go to the firm, I mean, if you go to bank, right, the bank might offer you Thai baht loan, right? The interest rate is 6%. But if you want to borrow US dollar loan, right, the interest rate will normally be different. Let's say 4%. Now, which one is cheaper? Which one is cheaper? You can't say directly that dollar loan is cheaper, right? Because the 2%, they are not in the same currency. So we can't compare them directly, right? We normally use IFE, right, to convert interest rate on one currency into another currency so that we can make comparison. So in this case, if I expect that dollar will appreciate against Thai baht by 3%, so that interest rate in dollar term, after I convert into Thai baht, so 4 plus 3, that would be 7%. So Thai baht loan is actually cheaper. So we have to compare 6 to 7, not 6 to 4. So this means that interest rate, right, even though it's already in percentage term, but it could be based, right, in different currencies and therefore not comparable. Okay. Right. Next, right. How after I identify the market, after I identify the proxy firm, right now I have to calculate beta, right, and the market risk premium, right? So because risk-free, we know that we calculate from the yield, right? We use yield to maturity of the bond, right, to represent risk-free. So we have two parts, right, that we have to calculate from the CAPM. Now this is a trick. The two parts, let's go back to CAPM equation. This is CAPM equation, right? Page 13. Let's go to the first version. So there are three inputs that I have to estimate, right? Risk-free. This is yield, right? Yield to maturity from government bond. We know how to do that already, right? From the topic on international financial market. So I still have two more inputs to estimate the beta. Okay, and this is what you have to be careful. The last part, this is called the expected market risk premium. Normally, when we estimate the expected market risk premium, we estimate as market risk premium, right? We do not separate the two terms. So we will not start with expected market return and then calculate risk-free separately and then subtract them later. We don't do that, okay? We do not do that. So basically, when you want to estimate the last term, right, the expected market risk premium, we estimate the risk premium as one number, right? We do not calculate this one first and risk-free another one and then subtract to each other. Normally, we don't do that, right? Normally, we don't do that. We calculate market risk premium as one number, okay? So you have to do some adjustment in my lecture note. I will show you how. So here, right, you better minus risk-free here because we want to estimate this whole thing as one figure, right? We do not separate them. So normally we can use historical information, right? Use historical return, right, of the market portfolio, right? And then average the number. Since we want to use this number for cost of capital calculation, right, to make investment decision. And the investment decision that we talk about tend to be long-term decision, right? Long-term investment. So when we estimate the market risk premium from historical returns, right, we have to decide two things. First, when we look backward, what is the interval? What is the interval that we will use to observe return, right? Basically, when we look backward, right, how often do we look back to collect historical information? So if I look back one day at a time, so that interval is one day. If I look back 1 week at a time, so today is Wednesday, right? Today is Wednesday. So I look back Wednesday last week, Wednesday 2 weeks ago, and Wednesday 3 weeks ago. So each interval here would be 1 week. So I can look back once a month, I can look back once a year. So this is called sampling interval. Okay, you probably have to write down this in case you are not used to it. So I have to identify the interval that I want to use, right? How frequent, right? How frequently I look back, right, to collect information. Since we want something for long-term decision making, therefore, when I look back, right, as a firm, right, when we make long-term decision, stock price movement from day to day or week to week doesn't matter that much, right? Just like if you are a long-term investor, right, you don't really check your portfolio every day, right? You don't rebalance your portfolio that often, right? As a long-term investor, you really look at it once a month or sometimes once a year, right? So since this is for long-term decision, I don't want to look back so often, right? Because I will capture a lot of noises along the way, right? So normally for market risk premium, we normally look back, right, on a 1 year interval, right? Look back 1 year interval, right? But when we look back, right, not only we have to decide how often do we observe, right? Another decision that we have to decide is what is the total length of the sampling, right, or the observation. So the next decision is how far do I look back? That is called sampling period. So how far do I look back? Now, since I use yearly interval, I have to look back quite a number of years, right? If I look back once a month, then I might not have to look back so long, right? Because what we need is that we need enough number of observations, right? So that we have reliable estimate, right? So what we do is that we collect, right, historical return, right? And then we use the average number, right? Use the average number to represent the expected market risk premium. Let me show you how. Here, right? This is today. (2011). So I look backwards 1 year at a time. Then I collect return on the SET index. So this would be yearly return, right? Look back 1 year at a time until 1991. Now, since I told you that we will calculate the market risk premium as one number, so what I have to do as well is that I have to collect risk-free rate at the same time. But in the Thai market, right, the secondary market for the Thai current bond has not been well developed, right, until about the year 2000. So I could not really find the yield on a current bond, right, that is available before the year 2000. So this is how far I can go for the risk-free rate. Right, but what I do next is that I find another proxy to represent the risk-free. That is, if there is no yield on the government, then I use bank deposit, right, as a proxy. But you might cut short. You might just cut short to the year 2000. But for me, I want to look back a bit further. So I try to find other proxy to represent, right, the risk-free rate. Okay, where when I cannot find the bond, right, of the government. Now, what we do next is that then you subtract between these two columns. Take the difference between the two columns. We will get market risk premium in each year. Then take the average of that historical market risk premium. Right? Take the average of the historical market risk premium. Right? To represent the expected market risk premium. So that's how we normally do, right, when we calculate that term, the market risk premium. Now, how far do I go back? How far should we go back? Let's look at this. Right, next slide. To try to answer how far shall I look back, right? What would be the appropriate sampling period, right? We know that I want to use the sampling interval of 1 year because I want to use long-term return. But how far should I look back, right? Here, right? This is the market risk premium for US market, average market risk premium, calculated between 2000 to 2009. And the number is negative. This should be no surprise because 2000, we have the, before the crisis, right? They have, I mean, in the year 2000, they have .com boom, right? They have .com boom and later on bust, right? 2008 to 9, we have subprime crisis in the US. So no wonder the average market risk premium during that period is negative. Most of the negative number must be driven by the last 2 years, right? 2008 and 2009. Question, does it make sense to use that number to represent the market risk premium? This is where estimating the number become both art and science, right? Does it make sense to use negative number representing the market risk premium? I want to know this part first. Does it make sense? Does it make sense to have that as a negative number? Does it make sense? If you think about CAPM, SML, you remember that the slope of the SML, because beta of the market is equal to 1, right? So the slope of the SML is actually equal to the market risk premium, right? That slope is equal to the market risk premium. And CAPM assume that it is positive, right? When you draw SML, the slope is always positive, right? It's never been negative. That is because CAPM assume that the market risk premium is positive. Why is that? Why is that? That is because we assume investor to be risk averse. It's very funny, right? That investor decide to invest expecting that they get negative return. That should not be a rational decision, right? Investor decide to invest, right? Hoping that they get negative return, right? Therefore, this is not rational, right? I mean, this doesn't make sense, basically. The thing is that we use actual return as a proxy for expectation. In terms of expected risk premium, it shall not be negative. But the actual risk premium could be negative because this is risky investment, right? Sometimes things turn against expectation. What you see here in the table, that's actual return, which could be negative. Makes sense? But we want to use them to proxy expectation, right? It doesn't make sense to assume that investors expect negative return on their investment, right? If they can actually put in the risk-free assets with positive return. So this is where choosing the period become both an art and a science, right? The rule of thumb, right? There is no right or wrong answer here, but the rule of thumb is that the period that we use, right, to calculate average market risk premium should cover at least one whole economic cycle, both boom and bust of the market. So normally we will look back quite far, right, to get the average number for this purpose, right, market risk premium. So normally we don't do that. We will look quite far backward, okay? Like in Thailand, right, we normally look back at least 10 years or more, right, to calculate this kind of number, okay? Right. I think at this point, let's go for a short break first, right? When we come back, right, I will finish up the rest of the issues, right? Not much left, actually. Okay. So let me stop sharing first. And I will, unless you have questions, right? But if not, let's go for a break first. We come back at 10:45, right? 10:45, I see you again. We're looking at how the market risk premium can be calculated, right? So the next step, right, is to calculate the beta, okay? So let me start from that. The beta calculation. With beta calculation, right, it depends on whether we use host country company as the proxy, or we use company from home country as a proxy. So this slide, right, page 21, this is the case where we use company from the foreign country, right, the host country as a proxy. So simply take the return, right, look back, right, for the stock return, right, and then calculate the covariance between the stock return with respect to the reference market port, then divide by the variance of the market port. So this beta can also be calculated from historical information, right? In case we use home country beta, so if we use a proxy from home market, then that beta, right, the beta of the home proxy can be calculated from the covariance and variance of the market as well, right? But if we use the home company as a proxy, that means we ignore, right, the diversification benefits of the foreign project, right? So using home proxy, we need to do some adjustment, right? We need to do some adjustment in order to take into account the benefit from diversification, right? That is, we need to calculate another factor, right? Beta FM. This is called country beta, right? This is called country beta. Multiply beta of a proxy company at home market, right, by the country beta. Country beta is calculated this way. Basically, when we calculate country beta, we treat the market, right, of the foreign country as a security and calculate beta of the foreign market using home market, right, as the reference portfolio. So this is the return of the foreign equity market. And this is the return of the home market, right? And then divide by the variance of the home market. This is as if we calculate the beta of the foreign market, as if the foreign market, the whole market, right, is treated as a security. Okay. Now, if the home country and the foreign market, right, has low correlation, that beta FM will also be low. So multiply to the home proxy, right? The beta of the foreign subsidiary will become lower. Basically, the last term, right, is there, right, trying to capture, right, diversification benefit of a foreign project. Okay. But if you use foreign proxy, right, in that foreign proxy, right, when we calculate the covariance with respect to the home market, right? If the two markets are lowly correlated, it will be reflected in that covariance calculation, right? Already, so we don't have to capture, right, that benefit from diversification as a separate term. But using home proxy, we need to capture the benefit separately, right? And that is in the form of what we call country beta, right? In the industry, they call that beta FM as country beta. Yeah. So that's how beta is calculated. But still, because when we calculate beta, we need to use return, right? Then next question arises, what should be the sampling interval? What should be the sampling period, right, for the return calculation to estimate the beta? Apparently, the sampling interval and the sampling period we use for beta calculation need not be the same as the market risk premium. Reason being that with beta calculation, right, we want it for long term. Therefore, the interval shall not be too short. However, if we use long interval, right, in beta calculation, we need to calculate the covariance and the variance, right? To get reliable estimate, we need to have enough numbers of observation, right? So normally in statistics, right, we will say as a rule of thumb, right, that we need at least about 30 observations, right, to get a reliable estimate. So if I use yearly interval, I have to look back 30 years. As for beta, we don't want to look back so far. Why? Because beta capture business risk. Beta capture financial risk of a project or a firm, right? Of a firm, let's say. But you know, right, firms, they change their business model over time, right? They change their the composition of their business portfolio over time, right? Think about PTT. If you look at PTT business, right, 10 years ago and today, right, quite different. 20 years ago also different. So firms, right, they change their business model, right? They change their long-term strategy over time, right? Firm start from startup, become growth and then mature, right? So as time passes by, firm also go through different phases of the life cycle, right, of the business. So beta will not be the same, right, as time passes by. Furthermore, right, they also change CEO, right? Probably every 4 years, 5 years, then they appoint the new CEO. Strategy also change. So with beta calculation, I don't want to go too far back because I will risk taking irrelevant information. So now we have to balance, right, between sampling interval that is not too short and the sampling period that is not too long. The rule of thumb, again, right, this is a rule of thumb. That means that there would be a lot of arguments to go for and go against this suggestion, right, is to use monthly return and to go backward, right, the sampling period of about 3 to 5 years. That is for beta calculation. Here, right, I take the return of a company called CPN, right? I took monthly return, right, during this period. So that's how many years? 2009, 10, July 2009, 2010. That's about 3 years period, right? That's about 3 years. So I have about 36 observation, right? 36 observation. I have return of the company, the stock here on the y-axis, return of the SET, right, during that same period on the x-axis. So this will be the observation that, let's say this could be, I'm not sure what it is, right? I just make it up. That could be the observation in July 2010. So basically each point represents each monthly observation, okay? So that will be the return on the stock. And if you map downwards, you get the return on the SET, right, on in that month. And then I estimate the line of best fit using Excel. Right? You can use Excel. Right? This is the equation that represents that line of best fit. Now, if you study the subject called investment analysis, right, you will recall that that line of best fit is known as the security characteristic line, right, SCL. The slope of that curve is the beta. So that's CPN beta. Okay. I also took beta that's provided by data provider, right? One from DataStream, another one from Reuters. Apparently their beta for the same company, CPN, are different from each other and also different from my beta. So it could be that first the period they pick and the interval they use could be different from mine. So if you decide to use already made beta from data provider, you should make sure that you understand how they calculate the beta, right? So that you can judge whether you think it is appropriate or not. Okay, that's beta calculation. Now, after you get all the input, then just put them together. Okay. One thing you shall change, right? I make the change in my lecture note, but your lecture note, I think on page 25, this part, I'm not sure. I think you are still the given information, right? In your lecture note, I guess is still the expected market return is 13%, right? I would like you to change that to the expected market risk premium equal to 10%. Because these numbers shall come as the risk premium. We shall not separate the two, right, from each other, because that is how they how it is estimated, right? Okay, make sure that you collect that part, right, in your lecture note. Page 25. So in the exam, if I give you the number, right, for that part, I will not separate between the market and risk free. I give you as the risk premium. Okay. Right. Okay, let's try this. There is a solution for this exercise, right, in a separate document for this topic, right? I have posted that on Blackboard since the very first day, I guess, right? So you can always go back to that solution, but let's try this together. This is a company from Finland, right, called Neargo, right? The firm, right, has a corporate-wide capital structure of 40% debt, 60% equity. I would like to calculate corporate-wide cost of capital in this example. Okay, so we will use this capital structure. This firm, right, has long-term bond, right, existing, right, in the market, meaning that the firm has issued this bond in the past, but the bond will be matured sometime in the future. So this bond still remains, right, on the firm's balance sheet, right? This bond carry a coupon of 4% per year. Okay, we have further information. First, the bond that I talked about just now, right? Even though the coupon rate is 4%, right? But the price of the bond in secondary market imply that, right? Imply that the yield to maturity of the bond is 5%. This is yield based on market price of the bond. So if you use your knowledge from other subjects, you will also know that this bond must be traded at a discount, right? From the face value, right? So basically that yield, right, imply that the price of the bond today is cheaper than the face value of the bond. Basically, those who can buy this bond at the market price, at maturity, they get the principal back equal to face value. So they will also earn, apart from 4% coupon, they will also earn capital gain, right? Then therefore total yield become 5%, right? When we calculate the cost of debt, which number do we use? 4% or 5%? Which number do we use? 4% or 5%? 5%, right? Thank you, Kun Attawut. Right, that's right, 5%. That one. Because when we calculate the cost of capital, we want to use current cost. We want to know the current market condition. That 4%, that is the result of historical decision, right? But we want the number that we will look forward, right? So we want the current cost, right, to make investment decision today. That's 5%, right? So we don't use 4%. Risk-free rate, right, in Finland, right, in euro term, that's 3%, right? The market risk premium, right, for the Finnish stock market, right, measured in euro term, right, that's 7%. Right, the market risk premium for MSCI World Index, right, converted into euro, right, that's 8%. The home currency in Finland is the euro, right? And this is the beta of NEARCO, right, using Finnish stock market as the reference market. And this is the beta using the world market. You notice that when we measure beta against the world, number become lower. And that should be no surprise, right? Because NEARCO is from Finland. The company could be quite a big company in Finland, right? Therefore, the correlation between the company return and the stock market return will tend to be highly correlated, just like PTT and the SET index, right? But when measured against the world, right, we would expect the correlation to be a bit lower, right, than comparing to the domestic market. Corporate tax rate is 30%, right? Let's calculate KE, right? KW, I want to leave that to you, right? Since you know what KD is already, you know the weight already. So the only thing that we need to figure out is KE. Okay, first option, using domestic version. So if we use domestic version, right, risk-free rate is 3%. Right, the beta is 0.85. Risk premium is 7%. So that's how we get cost of equity using domestic CAPM, right? Using international version, the result will be a bit different. Okay, let's put that down. International version, right? Again, we use the same risk-free. That's right. In the cost, in WACC, right? Cost of debt, you use 5%, right? Use 5%, correct. Oops, sorry, that's 60. Right, and the market risk premium, right, is 8%. So that's how cost of equity can be calculated. Okay, cost of debt is 5%. So once you're done with that, then you can calculate WACC, right? Okay, that's the answer to this question. Next. This part, I don't want to go into detail because we have done this many times, right? Convert, right? Return from one currency into another currency. So let me explain briefly, and then we will jump to the exercise, okay? When we calculate the cost of equity, corporate tax that you have to use. I'm so sorry. If you go backward, right? If you go back to this, I have the equation. I tell you the page. If you go to page 5, right? In the near goal, right? Near goal example, right? That is 5%. And that is the corporate tax rate, 30%. And the weight on debt, I can't remember, right? It's either 60 or 40% in the question, right? And KE just now, right? We put here. So corporate tax rate is used in the WACC calculation, right? In order to convert the cost of debt from before tax to after tax cost of debt. Okay, we normally have to convert cost of debt into after tax. KE, you don't have to do that because KE is always after tax. On itself, it's already after tax, right? Because the return that firms pay to the shareholder is after the tax is paid. But the return that firm pay to debt holder, interest payment, that is before tax is charged, right? So cost of debt before tax and after tax are different. That's why you have to do this. Okay. So the tax is given for this part. Okay, let's go back. Just now, right, when we calculate cost of equity for foreign subsidiary, if I use domestic version, that risk-free rate is in the form of home currency. The market return, the market risk premium is also in home currency. Beta has no currency. So that means this cost of equity is in the form of home currency. Now, when I want to use this to discount cash flow of foreign project, right? Most likely the cash flow from foreign project is in foreign currency. So the cash flow is in foreign currency, but the discount rate is in home currency. We can't use them together straight away, right? We have to convert either one, right, to the same currency. There are two choices. So basically, I want to calculate NPV. Let me put that down first so that you can visualize that. I need to input, right, cost of equity. Let's just treat it as cost of equity, right? Because cost of debt, we have to do the same thing. Expected free cash flow. Normally in foreign currency, right? Because the project is in foreign country, but the cost of capital is in the form of home currency. So we have to convert either one, right? So that they are in common currency. So I have two choices. I can convert cash flow, right, from foreign into home currency. to do that, right? To convert cash flow to home currency, we need to know the exchange rate. But the exchange rate that we use is the exchange rate in the future, right? Because that cash flow is cash flow in the future. So that means I have to use expected exchange rate in the future, right? To convert the cash flow. And then we can calculate NPV. Alternatively, I can keep the cash flow as they are, keep the cash flows as they are, but then convert cost of equity into foreign currency. We know that to do so, right, we use IFE equation, which require the estimation of expected exchange rate in the future. So that means either way, you have to forecast exchange rate, right? Either way, you have to forecast exchange rate, right? So as long as the forecasted exchange rate are consistent, right? Converting the cash flow or converting the discount rate give you exactly same result, as long as the forecasted exchange rate are consistent, right? So it doesn't matter which way you want to use, right? Because it involves forecasting exchange rate anyway, both, right? Let's say, right, if I want to convert this return, right, into foreign currency, how do I do that, right? Okay, this is a trick, right? It's a trick. From the IFE, right, the right-hand side of the IFE, right, we have 1 plus interest rate in foreign currency, right, multiplied by expected exchange rate. Okay, just bear with me for a while, right, while I'm writing this. Okay, this is the right-hand side, right, of the IFE when I move around, right, and we say that we can treat that right-hand side, right, as a way to convert foreign currency interest rate into home currency, right? So the right-hand side shows you how to convert foreign return into home currency. Now, if I start with home, but I want to convert into another currency, right? Now, if I want to use this kind of equation easily, I should always treat the currency that I start with as a foreign currency, and the currency that I want to end up with as home currency. Looking at the whole thing this way, right, I can just apply this equation straight away by not having to keep converting the exchange rate, right? From don't have to keep changing the base currency in the exchange rate, right? So if I start with Thai baht return, I want to convert into US dollar. I will treat Thai baht as foreign currency, and I want to convert that into home, which is US dollar, and therefore the exchange rate, right? The exchange rate must be quoted as number of dollar per baht, right? Basically, always treat the starting return, right, as foreign currency, and the one that you want to calculate as home. And that be easier for you to do the calculation. Okay. So now the second term, right? We also know that it can also be written as 1 plus the rate of change in exchange rate. Okay, and if I move 1 from the left to the right, This is how we convert return on one currency into another currency. Okay, let's try that, right? Keep in mind that C is the rate of change, right, in the value of the foreign currency, right? Okay. So you can figure out this by yourself, right? Just now I just wrote this one for you. Right. Let's do this together. Assume that the parent is a US firm, right? So the beta, right, of the Thai subsidiary, okay, this is a Thai firm. The beta of the Thai subsidiary is 0.8, right? This is risk-free rate from the parent's perspective. So this is dollar risk-free rate, 6%, right? Again, I should give you this as the market risk premium in the US, right? Equal to 4%, right? I should give you 4%, not 10%, and ask you to deduct risk-free later. Okay. So the firm want to, okay, let's calculate the cost of capital first. Okay, this is the cost of capital for the Thai subsidiary, right? Using cap M, right? Using cap M. So that will be 9.2%. This 9.2% is in US dollar term, right? That is because risk-free is also dollar, right? Market risk premium is also dollar. So that 9.2% is in dollar term, which is the home currency for the US firm. Now the firm want to convert 9.2 into Thai baht, right? Want to convert 9.2 into Thai baht to discount Thai baht cash flows. Now, as I told you, right, you always treat the one that you start with as foreign in this kind of calculation. So in this case, right, since the firm start with dollar return and want to change to Thai baht, I will treat dollar as foreign currency and Thai baht as home currency, right? And therefore, I can use this equation, right? So that is the return in US dollar. This is the rate of change in dollar exchange rate. And that just plug in, right? I would get return in Thai baht term. Okay. So that would be, here I do some rearrangement, right? It might look different, but because I do some rearrangement. Before you do calculation, can I ask you first, whether, do you think after conversion, the cost of capital will be higher or lower than 9.2? After I convert this return into Thai baht, right? Without calculation, do you expect the number to be higher or lower? By the way, the firm expects that in the future, US dollar will appreciate by 5% against Thai baht. So that means C, right? The rate of appreciation of the foreign currency is 5%. So should the final result be higher or lower than 9.2? Just use logic. The return in US dollar term, 9.2%. The firm expects dollar to appreciate by 5%. So if the firm receives return in Thai baht, right? In the future, the firm expects that they have to use more Thai baht to buy dollar back. So that means if the return comes in the form of Thai baht, the return must be higher than 9.2 because the baht return must also compensate for baht depreciation or dollar appreciation. right? And that is 5%. So the return in Thai baht term will be approximately 9.2 plus 5%. That's 14.2. That's approximation. Right? The actual calculation is 14.66. Okay, this is how you convert return, right? From one currency to another. We will need to use this kind of calculation when we do project evaluation, right? So just keep in mind, this is how to do it. This exercise, I have the solution for you in that separate document, right? So I will not talk about it. This question used to be in an exam, right? Sometime in the past. Basically, I assume a Thai firm, right, want to set up a factory in India. So the Thai firm have to calculate the cost of capital for that foreign project. So basically, I asked students to outline, right, the steps that involve with the calculation. So don't have to calculate. You just explain what to do, right, step by step. Okay, right. Okay, should the cost of capital be adjusted for currency risk? Because so far we only take into account diversification benefit of foreign project, right? We totally ignore the fact that foreign projects also, right, have more currency risk. It also has higher political risk. So the question becomes, should we adjust the cost of capital that we have calculated so far to incorporate these two additional risks or not? Okay, let me treat them separately. Let's start with currency risk. Now, I would like you to recall that there was one experiment showing that when investors diversify at home, right, that is the risk reduction benefit. But once investors diversify in international market, right, they can enjoy more risk reduction benefit. Right, there was a graph in the previous lecture note, right? In that experiment, the researcher assumed two cases: international diversification with exchange rate risk, basically no hedging, and international diversification without exchange rate risk, assuming hedging. Right? If you go back to that graph, you can see that the additional risk from exchange rate of international investment is not that high at all, very small. Basically, when we diversify equity portfolio internationally, right, somehow, right, that diversification, right, has a natural hedging toward exchange rate. And therefore, the additional risk from currency is not that high, as if investor can diversify this risk by themselves. Simply invest in many stocks in many countries. So to a certain degree, right, to a certain degree, that risk could be treated as unsystematic risk. And therefore, if it is unsystematic risk, it shall not be included in cost of capital calculation. Okay, so the answer to this is depends, right? Whether you treat this risk as systematic or unsystematic. But the result that I showed you from last class, right? It seems that this kind of risk can be diversified, right, to certain degrees, right? So I guess we can look at it as unsystematic risk. How about political risk? The risk that the government policy would change, right? Because the change of political environment, the risk that there could be political event, right? That will interfere with the economy, right? The risk that the law could change, that kind of things. You might include environmental risk in here as well, right? It captures a lot of things, basically political risk. Apparently, when it comes to political risk, since this risk is quite hard to measure, exchange rate risk you can measure into number, right? This risk you can measure into numbers, right? Because you can measure exchange rate. But when it comes to political risk, it's quite hard to measure, right, into numbers, right? Normally we describe, right, rather than measure, right? Except for some organization, right? They come up with an index number to reflect political risk. But those index numbers are quite objective, right? Are quite objective. Sorry, I should say are quite subjective. Because different people, when they measure political risk, you will notice that they come up with different way to measure, right? Different factor to focus, right? So this kind of risk is quite hard to measure objectively, basically. Quite hard to quantify as well, right? So when it comes to political risk, right? So far, there is no evidence to confirm whether it is systematic or unsystematic. So basically, we do not have conclusion, right, for political risk, whether it is systematic or unsystematic, right? For one reason, it is quite hard to measure and test, okay? So in that case, right, a lot of firms, right, will do this, right? They just add, right, a factor, right, called country risk premium to the cost of equity that they calculate, right? So basically, this is the cost of equity that they calculate for project at home, right? Or even the one that I showed you just now. And then add this term to reflect at least political risk, because it is riskier, right, to invest in foreign project. Now, when we do this, it implies that we treat political risk, right, as systematic risk. But I claimed just now that so far, right, there is no evidence, right, to confirm, right, that political risk is systematic, right? But if you do this kind of calculation, it implies that you assume political risk is systematic. Therefore, you add to the cost of capital. Now, let's assume I am okay with this. Okay, let's assume first that we are okay with this. There is still one question arises. How do you capture risk premium? How do you capture the risk premium of political risk? Remember, this kind of risk is hard to measure, and you have to measure it as risk premium. The unit is percentage per year. How do you convert political risk into risk premium? That becomes another question, right? Right. Given that I am okay with this kind of practice, there is still one question, right? How to measure risk premium of country risk? In practice, right? In practice, these three approaches are used, right, to convert political risk into risk premium. The first two are most popular. Therefore, let me talk about the first two. Okay. The first method is to use, they call this as sovereign credit spread. Sovereign credit spread. The second approach is to use credit default swap. Use the premium from credit default swap of government bond, right, to reflect risk premium. The last approach I want to skip, right? I don't have example here in this lecture note. Right? This is called relative equity market standard deviation. Okay. If you go through the three equations, you can see the step, right? These are the steps involved with the third technique, right? So that's the first step, right? Second step, and then you can derive that country risk premium. Okay, but let's focus on the first two. What do I mean, right, when I say sovereign credit spread? One way to measure sovereign credit spread, right, is to use government bond, yield on government bond, right? Let's say, right, if I want to measure sovereign credit spread of the Argentinian government, right, I will go to the market, right, and check, right, look for the government bond, right, issued by Argentinian government. But the bond that I look for must be bond denominated in foreign currency to Argentina, right? Because if it's Argentinian peso, then the bond will be risk-free, right, for Argentina. So I have to look for, let's say, dollar bond issued by Argentinian government. There are two markets I can look for that, right? I can look for euro bond, right? Euro dollar bond issued by Argentinian government, or I can look for Yankee bond, right? Yankee bond, right? Dollar bond in US market issued by foreign entities. So Yankee bond issued by Argentinian government, right? Either way, the one here, this is the yield on Yankee bond issued by foreign government. This is dollar bond. Therefore, there is a risk that foreign government might default, right? So I look for the yield on that bond. So assume that it is 13.18. Then I compare with the yield on US government bond, which is truly risk-free in dollar term. Deduct the two, that is called spread. This is called credit spread, right? But since the issuer is a national government, therefore we call this as sovereign credit spread. Multinational corporation normally use that spread to represent country risk, right, of Argentina. So let's say, right, if they want to invest in project A, the cost of capital for project A, if invest at home, right, let's say 10%. This is the cost of capital for the project at home. So if we were to go to Argentina, we need additional return of, basically we need additional risk premium of 7.18. So you add 7.18 to that 10%. That would be the cost of capital for a project in Argentina. So if I want to do the same project in Indonesia, right, Indonesia, so that would be the risk premium. So do the project in the US, cost of capital is 10%. Same project in Indonesia, that's 14%, right? Argentina, that's 17.18%. So this is what firms normally use to proxy for country risk premium. Another way to capture, by the way, this is sovereign credit spread for euro, right? For the currency euro, right? So what you see here, right? This is the spread between 10 years government bond, right? Over bond issued by German government. They call bonds, right? So basically that German bonds, that's Germany government bond, okay? So you can see that, let's say, right, I try to pick Greece is here, so that one. You can see that before 2008, right, actually subprime crisis start in 2007, right, not really 2008. So if I pick somewhere here, where the subprime really start, I think it's in July 2007. So it must be somewhere here. you can see that before the subprime, right, the spread between Greece government bond and German government bond is about 20 basis points. 20 basis point is equal to 0.2%, right? But after 2008, right, prior to the crisis in Europe, you can see the jump of that credit spread to almost 1%, right? And later on, it increased even further. So if the currency in the question is the euro, right? And if you want to measure relative to Germany, right? Then this is sovereign credit spread, right? Used to proxy country risk. Second technique is to use premium from the CDS, credit default swap. Basically, credit default swap, you can treat this as an insurance policy, right, against default risk of a bond. For example, if I purchase IBM bond, right, and over time IBM will pay me, right, basically when I purchase IBM bond, right, over time I get coupon from IBM, right, and at the bond maturity, right, investor receive the face value back. So investing in IBM bond, right, investor will face not only the risk of interest rate movement, but also the risk that IBM might default, right? So CDS allow investor to hedge against credit event like default risk. So if I want to carry on this bond, right, but at the same time, I want to hedge against default risk by the company, I can buy insurance, right? Go to insurance company or financial institutions, purchase the protection known as CDS. They will charge us premium. Of course, the premium being charged depends on default risk of the bond. So in that way, right, the premium on CDS acts quite similarly to credit default. Similar to the sovereign credit spread, right? Similar to credit spread here. So assume that, right, the face value of this bond is 100 billion. And the firm, right, that sell the protection charge investor 50 basis points for the protection. So this is the number that reflects credit spread, right, or credit risk of IBM. So protection provider, right, charge 50 basis point on the face value. So those who buy protection, right, will have to pay 0.5% on the face value, right? On maturity, if there is no default, then there is no claim. So insurance company get that 50 basis point, and investor get the face value of the bond back. But if there is default, then the company, right, insurance company will cover whatever the investor lose out, right, from the default of the IBM company. So we can use that premium, right, as a reflection of credit risk, and multinational corporation use that number, right, to reflect country risk. So this one shows you the premium, right? This is the premium, right, of CDS, right, to cover the one in blue, that is Greece government bond. You can see that during the height of the crisis in Europe, that premium becomes so high, right? So we can use that premium to reflect country risk, right? So that's how firm do, right? Use either sovereign credit spread, right, or the premium from CDS, right, to represent country risk premium. Now, this practice also has some problem, apart from whether the risk is systematic or not. Another problem with this kind of calculation is that if you think about two projects going to the same countries, two projects going into the same foreign countries, one project is to invest in a production of consumer goods like hair shampoo. Another project is invest in infrastructure project. Even though these two projects, right, invested in the same foreign countries, but you should also understand that the exposure to country risk, the exposure to political risk is not the same, right, between these two projects, even though they go to the same countries, right? A project that manufacture consumer products, consumer goods, this kind of projects normally do not carry a lot of political risk, right? But if the project involved with infrastructure, then you can see that this kind of project will affect, right, the welfare of people, right, in the foreign country. So the second project tend to be subject to a lot of intervention, right, by the host government, right? So in that case, right, I guess it is fair to say that these two projects, even though it go to the same country, it will not have the same exposure to country risk. The first equation, we treat the two projects as having the same risk, as long as the two projects go to the same country. So some suggest that that is not a good practice. So we should take into account the exposure to political risk, right, differently for different projects. To do so, someone suggests that how about put CRP in that bracket so that we can use beta, right, as a representative of exposure to political risk. But in this way, right, if the two projects has different beta, then the exposure to country risk will also be different. But this practice also subject to some comment, right, some critic, right, saying that beta is the exposure of business risk, right, relative to the market or the economy, right? But what we want for this term is the business risk toward political event, right? Business risk toward political event. So beta risk measured against overall economic performance, right, versus business risk measured against political event need not be the same as well, right? So in that case, right, we shall treat the exposure to political risk, right, or country risk separately, and separate that from the business risk, right, that is measured against the overall market or the economy as a whole. So that becomes the third technique, right, to incorporate country risk. But this third equation also have some problem. That is, how do we measure lambda? How do we measure lambda? We know how to measure beta, right? Covariance over variance, right? But political risk is quite hard to measure into numbers, and therefore lambda itself is also quite hard to measure. So the adaptation of that equation into practice become quite difficult in that case, right? Furthermore, people also comment that the numbers that firms normally use to measure country risk, right, that come from either the CDS or Eurobond, right? This spread reflects credit risk of a government, right? This spread reflects credit risk of the government. But what we want is the measure of business risk, not credit risk of the project or firm, right? So using this number to reflect country risk, we are using basically orange, right, as a proxy for apple. Because what we want here is something that reflects business risk related to political event. But the number that we proxy for the premium come from credit risk of the host government, right? So that might not be the same thing as what we want to measure. So this kind of practice, right, gets a lot of critics, right, from academic, right? So now this is what we suggest to do, okay? In academic, right, we argue that since there is no evidence that political risk is systematic, there is also no evidence that it is unsystematic. Basically, we don't have conclusion about the nature, right, of this kind of risk, right? Whether it is systematic or unsystematic. So when we are not sure, right, why not, right, drop that from the cost of capital calculation? Because if we keep adding risk premium to the cost of capital, right, we face another kind of risk, right, in the decision making. That is the risk of over discount and therefore negative NPV and reject foreign project. So since there is no evidence, right, for this kind of risk, whether it is systematic or not, right? So why not drop it from the cost of capital and capture this risk somewhere else? Now, if you think about NPV calculation, okay, NPV calculation. Okay, if I assume just one period cash flows, and then we discount by the cost of capital, right? The common practice in this kind of calculation is that we capture risk of the project through the cost of capital, right? Because we say that the cost of capital consists of two parts, risk-free plus risk premium, right? What we try to do just now is that we try to add another risk premium called country risk premium. Right, so basically add premium to the cost of capital, basically to penalize the project, right? Penalize project. So if the project is risky, cost of capital is high. Therefore, the chance of beating NPV to be positive become difficult. So that's how we normally, right, penalize project risk, right, in NPV calculation. But finance theory say that, right, only systematic risk should be captured in the cost of capital calculation. So if we are not sure whether political risk is systematic or not, why not we drop that, right? Why not we drop that and capture the risk somewhere else? Where else can you capture risk? Where else can you capture risk in your NPV calculation? There is only one component left where you can capture the risk in that calculation. That is the cash flows, the expected cash flow. So another way to capture risk into NPV calculation is to capture through the cash flow calculation, right? And normally, if the risk is not systematic, we capture that risk in the cash flow calculation. Only systematic risk is captured in cost of capital calculation. Okay, so basically, if you feel that you can't ignore this risk, if you feel that you cannot ignore this risk in the NPV calculation, right? The suggestion is that incorporate this into your cash flow calculation. Basically, when you forecast cash flows, right, you should have some kind of expected political event, right, that affect your forecasted cash flows. Okay, so that's what we will do next week, right? How to incorporate political risk, right, into free cash flow calculation. Okay, so right, so that's about the cost of equity, right? As for the cost of debt, right, I told you, right, I don't want to spend time because we talked about this many times, right, in the other topic. The other thing that you just have to keep in mind is that when it comes to the cost of debt, right, if the firm has existing debt, such as bond, right, if the coupon on existing bond is different from the yield to maturity of that bond measured from the market price, we use yield to maturity, right, as the cost of debt, right, not the coupon on the bond, right? Apart from bonds that are traded at par, then the coupon rate and the yield to maturity will be the same, right? In case they are not the same, right, keep using yield to maturity as the cost of debt. Okay, this is how to convert currency, right? Just I leave this to you, right, to practice. Okay, last part. The last part is capital structure. Okay, the last part is capital structure. This part can be quite confusing. Okay, let me show you an example and then we discuss. Okay. Okay, let's start with example and then I do backward, right? This is the balance sheet of the firm before foreign investment. Okay, so this firm, right, has debt to equity ratio of 0.67 to 1. Right, assume that is the optimum capital structure by the firm. Right, so the firm is at optimum capital structure. This is before foreign investment. Assume that in the asset, right, the firm has $50 cash there. Right, the firm has $50 cash on hand. Actually, cash can be more than 50. It's just that in that 1,000 total assets, right, part of it is cash holding. Now the firm would like to invest in a foreign project worth $100. This is a foreign project. Now the firm, right, view that the appropriate capital structure for this project, right, the appropriate capital structure for this project is 50% debt, 50% equity. You know, the firm capital structure, right, the optimum capital structure for the whole firm and the optimum capital structure for different subsidiary or different project could be different, right? Because different project has different level of risk, and therefore the appropriate risk or debt level, right, for each project could be different. Okay, so for this firm, right, it feels that this project should have the optimum debt level of $50 or 50%. So to achieve that optimum capital structure for the project, right, the firm borrow $50 and combine with cash on hand, right, of $50 to become 100 and invest that in foreign project. So after the investment, this is what happened to the whole firm, right? After investment, consolidated asset would be 1,050. Debt, right? That would be additional debt of $50, so that'd be 450, right? 600 equity remain the same. So this is the consolidated debt to equity ratio after investment, and this is also optimum, right? Basically, that is the average between existing debt, right, with the new project. So basically, that 0.75 to 1, that is the optimum capital structure for the whole firm, right? Consolidated firm. But for the project itself, right, debt to equity ratio is 1 to 1. Right? This is optimum capital structure for the project. Right? The one on the right hand side, that is for the consolidated firm. Now, when the firm, right, invests in foreign project after receiving $100, apparently that investment, when the firm want to structure, right, when the firm want to structure the capital structure of the foreign subsidiary or project, the firm can choose, right, whether to invest that $100. This is the money raised by the parent company, right? This $100 was raised by the parent company, right? So the parent company can choose, right, whether to put that as loan from the parents, $50, another half invest as equity holding from the parents. Or the parents can say that, okay, how about this? We lend you 70% of 100. Another 30 that become equity investment by the parents. This structure can also be done, right? But that $100 come from exactly the same source as case 1. Right? Basically, after raising the money, the parents can always choose, right, how to put that money in foreign subsidiaries, right? Whether to put everything as equity investment or split, right, between loan from parents, right, and equity investment from the parents, regardless of how that $100 is raised. You might want to ask, right, why don't the parents, right, use case 1 all the time? Basically, put the money to reflect where the money come from, right? That $100 by the parents, 50% come from debt, right? Another 50 come from retained earnings. So why not structure the capital structure of the foreign project, right, to reflect, right, where the money actually come from? That is case 1. Sometimes the parents might want to adjust the capital structure of the foreign project in such a way that, right, the structure doesn't really reflect where the money come from the viewpoint of consolidated firm. For example, if the parents, right, think about risk, right, risk of recalling investment back home. So if there is such risk, right, the risk of capital movement, right, in that case, right, the parents might want to put more debt into this investment, because if the parents invest as debt, right, or loan from the parents, that is a fixed time where the parents can call the principal back, because this is loan, this is not equity investment, right? So the risk of capital movement, right, could be one reason why the parents want to deviate the structure, right, from where the money comes from. It could also be tax management technique, right? Because lending money to the foreign subsidiaries means that the foreign subsidiary would have high interest payments and therefore reduce the tax payment of the foreign subsidiaries. Or sometimes the parents might want to conform the capital structure of the foreign project, right, to the norm of the foreign countries. So there are many reasons why the parents want to adjust, right, the structure, right, of the foreign project in such a way that when you look at the capital structure of the foreign project, it doesn't really reflect where the money come from, right? Last choice. In the last choice, right, the parents put $50 as equity, but ask the project to borrow money by itself. So the last one, the project borrow money by itself. Now, what happened is that, right? What happened is that 3 more minutes, then we finish. Okay, what happened is that if I use case 1, right, and consolidate that with the parents' balance sheet before investment, right? Consolidate case 1 to this balance sheet, consolidate case 2 to that balance sheet, case 3 as well, case 4 as well. I found that whichever case I use to consolidate, I end up the same balance sheet of the consolidated firm. Because in the 4 cases, right, the parents add $50 debt to the overall firm, right, and $100 spent on foreign investment. So apparently, whichever case the parents use, end up the same consolidated balance sheet. So question arises, right? Question arises. When we calculate WACC for foreign project, right? When we calculate WACC for foreign project, which capital structure shall we use? First, use the capital structure that we see from the project balance sheet. So if the parent use case 2, right, to finance a project, in that case, we use this as the weight in WACC calculation. That's choice number 1. Choice number 2 is to use consolidated capital structure before the investment. So that one, you have to go back to this one, 0.6721. Choice 3. Use consolidated capital structure after the investment. So in this case, right, whichever structure of the foreign project, right, we end up the same 0.75 to 1 debt to equity ratio. Last choice, use the project optimum capital structure, that is 50% debt, 50% equity. So which one do we use? Right? This is important, right? Because different choice, you end up different cost of capital. Okay, to quickly summarize this. Normally, when firms borrow money from lenders, right, whether it is bank or whether it is bond, right, lenders normally care about consolidated debt ratio. So in this case, right, if the parents have moral or legal obligation, right, to avoid this foreign subsidiary from defaulting. Basically, if the parents have the commitment, right, not to let this foreign subsidiary to default on loan, right, in that case, right, the appropriate capital structure, right, would be consolidated capital structure, because that will reflect the risk of the project better. So that means we can ignore choice A and choice B. Now, shall we use the optimum capital structure of the consolidated firm Or shall we use the optimum capital structure of the project, which could be different from the average of the firm? Right, two choices left. Now, because, right, the final capital structure of the firm, right, consolidated firm, that is a reflection of the average, right, capital structure of different part of the firm. So therefore, if we use that capital structure, choice C, it will not really reflect the project risk. Remember, capital structure has to be project specific. And since the target consolidated capital structure for the whole firm depends on the target capital structure of different projects, right, combined. So the argument is that we should use choice D dot. So choice D would be the one that is the most appropriate, right, for project capital structure. So what we learn from here is that, right, when you decide on the weight, right, do not be deceived by the look of the project balance sheet, because sometimes the project balance sheet will deceive you, right, about where the money actually come from. Okay, so choice D, right? Okay, I'm so sorry about the time, right? But I finished now, right, for this topic. Do you have questions you want to ask first? Which are the lecture that will be in the final exam, right? Will be lecture 7 until what is the number of this lecture? Until next lecture 13, sorry. So the lecture that I cover, right, start from number 7 to let's make sure, right, I do not get the number wrongly. So lecture 7 until lecture 13, right, next week lecture. Okay, I will drop the last one, right? The last one have to do with letters of credit and things, but I found that students normally have to do another subject called something to do with business management, right? And they normally talk about letter of credit in that chapter, in that subject. So I will drop topic 14, okay? Only cover until topic 13. So start from currency and interest rate derivative, right? Currency and interest rate derivative until next week topic. How do we write? In the exam, right, with the multiple choice, right, you simply use the mouse, right, to click on the choice of your selection. For short answer question, you type in. So after the question, right, there will be a box, right, empty box for student to type in. And I will normally tell the computer, right, how many lines that student can write, right? So you type it, right, using the keyboard to type. Okay. So this time everything will be done online, right, through the Blackboard application. Right? Which question? Yes. Kun, not sure. Is it your name? Kun Cha Cha, right? Which question? You can turn on microphone so that I can go right to that question you talk about. In the exam. What do you mean? So sorry. How about turn on microphone and ask me?
คือหลังจากตอบตอบคำถามแล้วสามารถย้อนกลับไปคำถามก่อนหน้าได้
Okay. I will try to set. I still learning. In these few days, I've been looking at a lot of YouTube. I'm still learning how to do that. Yes, but I will try to set the exam in such a way that you can change your mind as you go through. So what I will do, right? You will see the exam in one page. Basically, the whole exam in one page. So you have to scroll down. So yes, I try to make it in such a way that you can always go back and change your mind, right? But at the end of the exam, you must not forget to click submission. Okay, you have to click submit. Otherwise, your answer will not be registered. And also, if you have a chance that, right, while you do the exam, the internet, right, your signal might somehow got disconnected, right, or you might have blacked out in your place, right? If you don't save your answer, I'm not sure whether when you come back, right, the answer will be there, right? So I still looking for the answer for that kind of event, right? How? So what you shall do, right, is that try to save, right? Try to save your answer along the way, right? But I will try to set up the exam in such a way that you can change your mind, right, before the end. Okay. Right. Any more questions? Okay, if not, right, then I end the class here, right? I'm sorry about the time, right? I see you next week, and that will be the last topic, right? The last topic is about project evaluation, okay? Right, I see you again next week.